You open your phone and watch a stranger turn one lucky stock trade into a small fortune. Your savings account looks embarrassed. Your retirement plan looks asleep. Then someone suggests buying an index fund, which sounds less like becoming wealthy and more like choosing beige carpet. Why would the most boring investment in the room be the one that can make an ordinary person a millionaire? That boredom is the advantage. An index fund is a basket that owns tiny pieces of many companies and follows a published list called an index, instead of paying a manager to guess which stock will explode next. A broad stock market index can spread your money across hundreds or even thousands of businesses. One purchase can give you factories, banks, software companies, pharmacies, railroads, and probably several corporations selling subscriptions you forgot to cancel. You are not betting on one genius company. So what are you actually betting on? You are betting that productive businesses will keep earning money over long periods. Some will fail, some will become giants, and the index automatically gives those growing companies more weight, while shrinking the importance of companies that fade. Your portfolio does not need to predict the next winner, because it gradually owns more of the winners as the market recognizes them. Could laziness really be this organized? John Bogle built his career around that question. In 1976, Vanguard introduced a low-cost index mutual fund for ordinary investors, meaning a pooled investment that simply tried to copy the S&P 500 rather than outsmart it. Critics mocked the idea because settling for the market average sounded unambitious. Wall Street was selling brilliance, forecasts, and confident people pointing at charts, while Bogle was selling a machine that mostly sat there. Which product sounds easier to charge a dramatic fee for? The logic became sharper in 1991 when Nobel Prize-winning economist William Sharpe published The Arithmetic of Active Management. His point was almost annoyingly simple. Before fees, all active investors together must collectively earn the market's return, because together they effectively make up the market. After fees, trading costs, research bills, and management charges, the average active dollar must earn less than the average passive dollar. How do you beat arithmetic with a nicer suit? The data has repeatedly made that arithmetic uncomfortable. The S&P Dow Jones Indices SPIVA scorecard tracks how actively managed funds perform against market benchmarks, which are simple measuring sticks such as the S&P 500. In its year-end 2024 report, about 84% of large company U.S. funds had underperformed the S&P 500 over the previous 10 years. Over 20 years, the share was about 92%. If professionals struggle after costs, why does your brain still believe one exciting tip will save you? Because excitement feels like information. Daniel Kahneman and Amos Tversky showed through decades of behavioral research that human judgment is pulled by shortcuts, emotion, and loss aversion, which means losses usually hurt more than equal gains feel good. A hot stock gives you a story, a villain, a hero, and a reason to check your phone 17 times before lunch. A broad index fund gives you a quarterly statement and the emotional intensity of a dishwasher manual. Which one is your attention economy designed to sell you? That difference matters because wealth is not only a math problem, it is a behavior problem wearing a calculator costume. The best portfolio on paper becomes useless when panic makes you sell it at the bottom, greed makes you chase it at the top, or boredom makes you replace it every 6 months. An index fund removes many decisions, and every removed decision is one less opportunity for your nervous system to sabotage your bank account. Could simplicity be a form of financial self-defense? Now reconstruct the millionaire path. Imagine you invest $500 at the end of every month into a low-cost broad market index fund for 35 years. Assume an average annual return of 8%, not as a promise, but as a clean illustration of how compounding works. Compounding means your gains can earn their own gains. So each layer of growth becomes part of the base that may grow next. What does that boring routine become? Your deposits add up to $210. That is real money. Yet at an 8% average return, the account would grow to roughly $115 million before taxes, because more than $900 would come from investment growth rather than your direct contributions. Your money eventually does more of the lifting than your paycheck. When does the machine start looking less boring? At first, almost nothing seems to happen. After 5 years, the account is still small enough to feel insultingly ordinary. After 15 years, the curve begins to bend upward, because earlier gains have had time to produce new gains, and those gains can produce more gains. During the final decade, the same monthly deposit can appear almost irrelevant beside the movement of the much larger balance. Why does the last part look magical when the first part felt pointless? Time is the hidden employee. It never asks for a raise. It works nights, weekends, holidays, and every dull Tuesday when the market closes without giving you a reason to post anything. Starting 10 years later does not merely remove 10 years of deposits. It removes 10 years of potential growth on every dollar that could have been invested earlier. How expensive is procrastination when the bill is paid in lost decades? Consider the same $500 each month at the same hypothetical 8% return over 30 years. The result is about $745,000. Over 40 years, it rises to about $175 million. The extra decade adds $60,000 of new contributions, but roughly $1 million to the ending balance, because the older money has had another decade to compound. Is your greatest investing advantage really a stock tip? Or is it simply being early enough to wait? Fees quietly attack that advantage. An expense ratio is the yearly percentage a fund removes to cover operating costs. And it sounds harmless because 1% looks like pocket lint. Yet $500 a month, growing for 35 years at 8%, reaches roughly $15 million. While the same pattern growing at 7% reaches about $900,000. That 1 percentage point gap can cost around $250,000 in this illustration. Why does Wall Street describe a permanent slice of your future as a tiny fee? Low cost is not the same as no risk. A stock index fund can fall hard, stay down for years, and hand you a statement that looks like a small financial crime scene. The dot-com crash, the 2008 financial crisis, and the sudden 2020 pandemic collapse all punished investors who expected a smooth staircase. An index fund protects you from the failure of one company, but it cannot protect you from the entire market having a terrible year. What keeps the plan alive when every headline tells you the world has ended? Your time horizon does. Money needed next month, next year, or for a near-term emergency does not belong in a volatile stock fund because volatility means prices can swing sharply when your deadline does not care. A cash reserve can keep a broken transmission, medical bill, or job loss from forcing you to sell investments during a crash. Bonds can also reduce the ride's violence, with a bond simply being a loan to a government or company that pays interest. How much risk can your real life tolerate without making you abandon the plan? Warren Buffett gave unusually plain instructions in his 2013 shareholder letter. For money left for his wife's benefit, he directed the trustee to place 90% in a very low-cost S&P 500 index fund and 10% in short-term government bonds. That recommendation did not claim that an index would win every year or fit every person. It showed that even a legendary stock picker saw low-cost diversification and patience as a powerful default for someone who did not need to turn investing into a full-time profession. Why would the expert choose something so simple? Because ordinary wealth is usually built by systems, not moments. Automatic monthly investing is called dollar cost averaging, which means buying a fixed dollar amount on a schedule whether prices are high, low, or awkwardly doing nothing. When prices fall, the same contribution buys more shares, and when prices rise, it buys fewer. The method does not guarantee profit or prevent losses, but it removes the impossible demand that you identify the perfect day to invest. How often has waiting for perfect conditions quietly become permanent waiting? The counterintuitive twist is that an index fund does not make you rich by being average. It can make you rich by helping you avoid below-average behavior. The fund does not panic, read rumors, revenge trade after a loss, or decide that a celebrity launching a digital token must represent economic progress. It simply follows its rules while your future depends on whether you can follow yours. Is the real competition the market or the person holding your phone? That does not mean every product labeled index fund is sensible. A narrow index can track only one industry, one country, one trend, or one fashionable theme, leaving you concentrated instead of diversified. Concentration means too much of your outcome depends on too few investments, which can make the ride much more dangerous. A broad, low-cost fund tracking a large section of the market is very different from a fund built around whatever topic currently makes social media breathe heavily. Does the label describe the strategy, or merely decorate the packaging? Your account type matters too. A workplace retirement plan or an individual retirement account can offer tax advantages, meaning the government may delay or reduce taxes under specific rules. But contribution limits and withdrawal rules vary by country and account. An employer match is especially powerful because it adds company money when you contribute your own. subject to the plan's terms. Ignoring a match can resemble leaving part of your compensation in an office drawer. Because the paperwork looked annoying, how much wealth disappears through decisions that feel too small to matter. Inflation also changes the picture. Inflation means prices rise over time. So a future $1 million may buy less than $1 million today. That is why the goal is not worshiping a round number, but building purchasing power, meaning the amount of real life your money can pay for. A diversified stock fund has historically offered growth potential, but future returns can be lower, higher, or negative for long periods. What would financial freedom cost in the prices of your own future? The process remains almost offensively plain. Spend less than you earn. Keep emergency cash. Pay attention to expensive debt, especially balances charging high interest. Because an investment return is uncertain, while a credit card bill can compound against you with impressive reliability. Then automate a sustainable amount into diversified low-cost investments and increase it when your income rises. Which part is glamorous enough for an algorithm to recommend? Probably none of it. That is why the system works quietly, while financial entertainment searches for explosions, predictions, and people who claim a chart has revealed destiny. Your wealth does not need to look impressive on Tuesday. It needs to survive recessions, distractions, career changes, bad moods, and several thousand chances to buy something that promises a faster answer. Can a boring plan outlast your appetite for novelty? A millionaire index fund investor may never discover the next superstar stock. That investor may never make a heroic trade, correctly call a market crash, or explain monetary policy from a rented sports car. The fortune can come from owning productive businesses broadly, paying little for the privilege, adding money repeatedly, and refusing to interrupt, compounding for reasons that feel urgent but age badly. The ordinary action becomes extraordinary, only because it is repeated for an extraordinary length of time. You open your phone again, and the stranger's lucky trade no longer looks like the path to your fortune.